Hey, good morning, everyone. Marty Mazzora here. It's Friday, the 4th of August, 2023. This is your weekly economic update. I'm also going to update you on the four charts that we looked at midweek, which are the S&P 500, the NASDAQ 100, Amazon, and Apple. I want to update you on those because we had earnings announced yesterday evening, and we had our jobs number this morning as well. And just want to look at market action in light of those important announcements. In front of you is the chart of our PWA index. We are stuck at a minus 17, which to us means odds lean toward recession over the next few months versus continued expansion. Each week I handpick from our 47 inputs and share with you what we're seeing. We'll start this week with mortgage purchase applications. And despite the action that a lot of people are talking about in the residential real estate space, multiple offers on homes, overall activity continues to wane or stay at historically low levels when we look at mortgage purchase applications. As we know, this sharks in the water feel when it comes to existing homes has simply to do with lack of inventory, lack of homes for sale. Folks are in no way interested in paying up for their mortgage debt. They have, a lot of people have locked in, 3% mortgages, let's say, are in that range, and that's tough to give up when you're looking at anything that you'd buy closer to 7% if you had to mortgage your house. So builders are doing well. Builder optimism is up, but they're offering incentives. From what I understand, a lot of them are buying down the mortgage rate and so forth to incentivize and entice people to act. But to the extent that there are buyers out there, there are very few sellers in the existing market, which of course makes for what looks like, at least perhaps on the surface, is a pretty robust new homes market. I also understand that a lot of that supply is coming, and you know how economics work. The more supply comes in, once it meets or exceeds demand, then you get prices leveling off or coming down. So again, interesting take out there. As I've suggested over and over again, clearly there has to be distortions when you look at the trillions of dollars that were pumped into the economy, distortions both with regard to macro setups, financial markets, and so forth. So we've got to stay on our toes and keep crunching the data and being open-minded to all possibilities. The jobs number came out this morning. It was disappointing, or I should say it was below expectations of 200,000 new jobs. The actual number was 185,000. However, the unemployment rate stayed down there at 3.6%. Average hourly earnings actually ticked up at what I think we could assume is a pretty inflationary rate. So the weaker jobs number, I think initially was met with a rally. The market's been positive, negative. I think it's positive again right now, talking about the equity markets. Bonds reacted, bonds rallied, yields came down. But what is concerning with regard to what the Fed's trying to accomplish are things like hourly earnings going up, right? i.e. inflationary. The quits rate dropped to 2.4%, so that's the rate at which people are quitting their jobs. The higher the rate, the more optimistic people are, because people don't quit unless they have something better waiting for them. So that coming down denotes perhaps a weakening economy. Job openings have dropped a little bit as well. Again, still hugely high levels, but the trend is lower. Labor force participation rate still at 62.6%, and the U6 unemployment rate, which includes discouraged workers, people working part-time who would rather work full-time, stays down there at the 6.9% rate. So nothing really dynamic here, therefore we didn't get this monster move in the market. Just essentially says that the economy is hanging in there and the labor market is still relatively tight, i.e. relatively inflationary. So it certainly doesn't inspire the Fed to cut rates anytime soon. The Institute for Supply Managers indices were out this week. As you can see, although we had a little bit of an uptick, 46.4 is still resoundingly in recession territory for manufacturing. And the services survey, while still in expansion mode above 50, this last month turned over a bit. Of course, 1 month does not a trend make. Our ultimate expectation is that services do decline and get into recessionary territory at some point over the next few months. Of course, that is what I should say odds favor based on our present analysis. On the other hand, heavy truck sales, which haven't been bad economic indicators, continue to fly in the face of these recession odds that I keep talking about. So as you can see, we popped higher after coming down a bit the previous month. As you can see, that's not a recessionary look, right? This is a recessionary look. So again, there's a bit of information that would speak positively. Now we can get into, lack of supply in the past, previous orders that are now being fulfilled and so forth. So there's probably some argument there, but at face value, that's a positive. Purchasing managers indices across the world, JP Morgan, their global PMI index continues to go in the wrong direction at 51.7, still expansionary, but lots and lots of countries are under that 50 mark. So that would be a warning with regard to the overall global economy. The U.S. Economic Surprise Index continues to defy, right? At 78, that suggests that the data has come out markedly better than what economists had expected. However, in the rest of the world, we've got a minus 94 in Europe, which is remarkably low, getting a little bit better. Negative still in Japan, very negative for China, slightly negative for the emerging market complex overall, and globally slightly better than what economists had expected. So we'll see. You could argue that the U.S. is leading the way and the rest of the world's going to catch up. You could also argue that the U.S. was resoundingly the champion of stimulus measures during and post-COVID, more so than other countries, and that this is the reality that ultimately the U.S. is going to face. So that remains to be seen. We'll keep crunching the data, scoring our various metrics, and reporting to you as we go. So I'll stop there on the economic update. And let's just take a quick look at markets. So we've been painting this pretty heavy picture for the stock market. As for the S&P, broke below a rising wedge pattern with bearish divergences and a sell signal on the MACD. So that would have been a sell signal right there. Be highly the norm to come back and test that uptrend line before rolling over hard, if indeed that's what ultimately is going to happen. As for the NASDAQ 100 index, as you can see, since I reported to you, it broke below this more or less a rising wedge pattern with these very definite bearish divergence and a very strong sell signal. So this is, again, a real bearish look for the NASDAQ 100 index. Not at all out of the question that we would ramp up, test this uptrend line right here before failing, or recapture it. Speaking of recapturing it, remember we took a look at Amazon, and Amazon reported earnings on Thursday, and I was showing a pretty bearish setup for Amazon. You had your rising wedge pattern and these classic divergences. Well, Amazon beat expectations and had a pretty good outlook. So consequently, the stock has really popped and is doing what I just suggested may happen, and that's testing the uptrend line here. If it passes that test and maybe comes back and then retests support and we're off to the races, that's possible. It's not our base case, at least for the overall market. Of course, we now have quite the gap right here in this big bounce, and a high percentage of gaps ultimately get filled. So we'll see. We'll see if Amazon can hold that impressive rally. It's like 9 or 10% so far this morning. And then Apple, I said, also had a very bearish looking chart, and indeed Apple had this rising channel. We were in that channel the other day, broke below it in anticipation of poor earnings, and that's played out pretty much as the technicals would suggest. So unlike Amazon, Apple, their earnings were fine. I think iPhone sales were disappointing. Revenue didn't beat for like the third consecutive quarter, something like that. Don't quote me on that, but wasn't great, and Apple stock is paying for it so far this morning. Now, in closing, I wanted to just kind of share with you. We've talked off and on the last year or so, about the underlying dynamics having to do with the dramatic volume we're seeing in the option space and how dealer positioning ultimately can move markets in a big way, right? So here's just a note that I sent to Nick early yesterday morning. Interesting, although it's probably closer to the close that matters, the call skew right now is bullish for Amazon after hours earnings today. But apparently there's no such action for Apple. Last week, and Nick and I explored this last week as well, was the same setup for Alphabet, meaning Alphabet or Google had huge call buying leading into the earnings announcement. And that call buying inspires ultimately as the earnings are announced, and Alphabet in that case spiked higher. All that short call exposure, the folks who sold those calls need to buy exposure to Alphabet to protect themselves from getting killed if it continues to scream higher. And what happens? That buying pushes the price higher, right? And for Microsoft, which had virtually none of that action. Now, Microsoft was basically left alone in the options pit, and it plummeted on its earnings announcement. Yesterday morning, Amazon was seeing that big options push that could potentially lead to a very big spike, where Apple was getting no such love. And it turned out virtually the same. In terms of direction, exactly the same. Amazon, as I mentioned, spiked higher. Apple has been down as much as over 3% so far this morning. So folks, this is really important to at least understand that there are forces underneath the market, to some degree manipulatory, that push stock prices around. And make no mistake, this kind of action has been happening in a big way on the S&P 500 index so far this year, I'm sure on the NASDAQ 100 as well. So while we spent a lot of time on the technicals and the fundamentals, some of this volatility and this extreme price action, and maybe to some degree this big bullish look that the market has had so far this year, has been to no small degree just what's going on under the surface. In this example, a market, or in this case a stock, seeing massive upside moves, not necessarily because there's massive, optimistic buying there, but there is the kind of hedging going underneath where certain actors are forced to take positions that ultimately impact the stock price. So interesting stuff we're working harder to get our head around. We are looking to people who spend all their time in that space for more insight. And this just gives you a tidbit of what that insight, at a minimum, can tell us in terms of some of the short-term dynamics and keep us from making decisions on what may be perhaps faulty observations about what's really pushing markets around. So I'll leave it there, folks. Thank you, as always, for watching and listening. Hope you have a wonderful weekend. I'll talk to you again next week. Take care. Bye-bye.